Alright, so welcome to this video tutorials where I want to help you understand what an imbalance is or fair value gap. Alright, but before I begin to explain to you what fair value gaps are, I want to first of all ask yourself, have you ever wondered why the world is so keen on striking a balance? I mean, virtually everything we do has to do with balance. When you're walking, you're talking, you're doing a whole lot of things, you always try to seek a balance. Even when you're trying to balance your career life with your spiritual life with your work life, all of these things, balance is always a key factor there, right? So just as balance is important in the real world, balance is also very important in the crypto market, right? Because basically in the crypto market we have two major forces, that is the buy force and the sell force. So between these two orders, right, there has to be a balance, because if there's no balance, the market would most likely be tilting one side. There has to be a balance between the buy and the sell orders, right? What is making the price of Ethereum today to be at $1859 is because of the influence of the buy and sell pressure. There's a balance there. Now once there's no balance, either when the buy pressure is more than the sell pressure, then there's going to be an a surge in the market price. The market is going to keep on pumping anyhow, right? And of course, the moment the market is keep on pumping anyhow, then there's a problem, right? And then once the sell pressure is also more, then the market is going to keep on dumping. So normally when you hear a coin rug pull, what causes that the influence of the sell pressure was actually more than the buy pressure. So that is why the coin could not hold a particular price, hence the coin fell down. Right, so there are ways that we can actually identify this imbalance in the market, and that is where the idea of fair value gap come into place. All right, so I'm going to just be doing some illustration. So yeah, we are able to monitor these fair value gaps by studying candlestick, because remember we said candlesticks are what are the pictorial illustration of the price volatility. That is, if you want to know the buyers or sellers pressure, when you look at your candlestick, they have a lot, or they say a lot about the price volatility. So if you want to understand whether there's a balance or an imbalance in the market, looking at the candlestick alone is going to give you a good idea of it. All right, so let's assume that this is a candlestick, right? Let's say this is a um bullish candlestick. Give me a minute. All right, so let's say this is a bullish candlestick, right? So this is our week here. now now this is a candlestick. Remember I told you guys that when you're looking at candlestick, right, every candlestick is actually connected, right? So after this particular candlestick, pardon me, I'm coming. Give me a minute. Right, so now this is the first candlestick, right? So you can see that the price volatility is going upward. Now when the buy pressure is so much, right, the next candlestick would still come up and continue being a bullish candlestick, right? Now when the other candlestick is also very bullish too, the candlestick would keep on going upward here, right? So this is an example of what we mean by when there is a ton of buyers pressure in the market. I'm trying to edit this candlestick, trying to draw them properly. Right? So now this is what we mean by when the market is in an uptrend. So in this particular case now, we can say that what the market is significantly going upward, meaning that what the buyer's pressure is significantly more than the seller's pressure. Right? So now what is the most significant indicator that the buyer pressure is more than the seller pressure? Is now what we call the fair value gap. That is the FVG, the fair value gap, right? So how do you identify this fair value gap now? To identify fair value gaps, you need to first of all spot three candles, right? So before you identify a fair value gap, there has to be three candles. So you can see in this particular case now you have candle 1, candle 2, candle 3. Right, so it's only when you have three candles that you can now spot the imbalance now. So look at this particular situation now, look at this week now. This is where the week stopped, right? So discover that the moment this particular candlestick went up here, the week stopped here, and then look at where this is where the week is. This one, now see where the week is, right? So you see that there's a space here. There's a space. I don't know if you understand. So that space now is what we call imbalance or fair value gap, right? So the market would always seek towards to fill in this imbalance. Now filling this imbalance might happen either immediately or it might take a period of time for it to be filled. But then most likely the market would always come back to fill in imbalance, right? So normally now, but for this market to be balanced now, but it means that had it been this week, I'm sorry, Had it been this week came and what? Remember I told you that every candlestick is connected. There's an interconnectedness between every candlestick, right? So had it been this candlestick came on board now, this candlestick now you can had it been this week now came up and what and filled here, then would have said this is the what this is good. This would have been a balanced market. I don't know if you understand, but because of the moment the market was pumping, this one filled, and then this particular one did not give us. I'm coming. Right, but because of the as the market was pumping now, this gap was created. This was now lead to what we call what the imbalance, right? So whenever you're looking at your chart now, right, if you pick three candles, if you want to know if there's an imbalance in the market, pick three candles, right? Three candles, then look at it now. The wick of the first candle and the what and the third, okay, sorry, the first candle and the third candle, check their wick. Okay, now if you look at this particular candle, this is the week here and this is the week here. So once the week are not connecting, there's an imbalance here. Right, so the market would always what seek to fill in this imbalance. Now it might come back to fill the imbalance immediately, or sometimes it might what go up. After a later time it might what come back and fill the imbalance. But because of there's an imbalance, it means the market is not what the market is not, let's say the market is not healthy, right? So imagine standing on one foot, you cannot stand for long. So until the market comes back and fills this imbalance, then the market cannot proceed further, or it cannot experience any significant movement, right? Now what causes this imbalance? Now it is mainly caused by what? When there's a huge buyer or seller's pressure, right? Now let me show you an example on the real chart, right? So look at this particular case now, right? In this particular case now, we have an imbalance. Now look at this red candlestick now. We have an imbalance there. No, let me start from here. Look at this green candlestick here. We have an imbalance there, right? But see how the market has come down to fill in the imbalance. Now where's the imbalance now? Let's pick this particular one first and see, right? Let me zoom in so you can see it very well. Okay, now let's monitor the now what caused the imbalance here. Now there was a ton of buyer pressure. That is why you can see this big green candle. So the buyer pressure was too much, hence creating this what imbalance. So if you take this first candle and this third candle right now, but look for their wick, right? Where's the wick of this one now? So this is the wick of this particular candle, right? This is the wick here, and what this is the second wick here. You can see very small wick now. So this is the first imbalance. This is one imbalance that the market has. All right, let me do something. Don't just stay with me. This thing is actually very easy to understand, right? It's not something that is hard. Okay, like I said, look how the market was going now. The market was actually what pumping massively, right? So now this is where the first imbalance is, right? But then the price volatility was still much. Remember I told you that the market is made up of two forces: the buyer and the buyer and the seller pressure, right? So there has to be a balance between these two pressure for the market to be what? For the market to be healthy. So once any one of these forces is more than the other, then the market is in an unhealthy state, right? And of course the market will always seek to create that balance, right? So look at the moment the market created this imbalance here, it was still pumping. So let us analyze this. Let's now check if there's an imbalance in this particular candlestick here. So let us look at this first candlestick and then the third candlestick, right? So looking at that one too, let's bring our you can see we have the first candlestick here, we have the first week here, then we have the second week here. So let me change the color here so that I can, right? So now you can see now that we now have two imbalances there. The red one for this, the red one is for this, sorry, the red imbalance is for this green candle here, then the next black imbalance is for this big other one here. You can see how I did it. Remember I said for you to measure imbalance, you take the first candle and then the third candle. You always use three candlesticks to examine imbalance. So now based on the word of imbalance number, the market would always try to seek imbalance by coming to clear this imbalance or fill this imbalance. How the market come and fill in this imbalance? The price action must come down to fill this imbalance. I don't know if you get. So now filling this imbalance might happen immediately, in the sense that the market might just go up and come and fill it immediately and go up. While other times it might be going up. After a later date that it will come down and fill the imbalance, right? But in this particular case, now let us see if the market fill the imbalance immediately or not. All right. So let's play the market. Okay. Now you can see. Now are you seeing how beautiful this? Are you seeing what just happened there? You can see the massive price drop. Now this massive price drop was in an attempt to fill in the imbalance. So whenever the market creates an imbalance, now imbalance, let me type it here, right? We call them imbalance or fair value gap. imbalance, in, imbalance or fair value gap, FVG. Yes. So this is what we call them, imbalance or fair value gap. All right. So you can see that the market is what the market is now coming down to fill in the imbalance. So this particular imbalance here is no more existence again because it has been filled here. So this black imbalance is no longer there. So we just delete it because this is no longer an imbalance there. The market has now created a balance there. So the next imbalance that we have is what is this particular imbalance here, right? And even this particular imbalance now, the market has covered, let's say, 65% of the imbalance. Look at it now, because the market actually what came down and covered at least all, but it did not cover all completely. There is still what part of it. All right. So now, since there's still part of it, have it at the back of your mind that the market must surely come down to create this imbalance. Like I said, it might decide to just come down immediately. Some other times it might just decide to keep on going up, but to surely come down or to fill in this imbalance. Right. So, and of course, the moment the price action keep on unfolding now, you need to keep on scouting the market for imbalances too. Right. So look at this candlestick now. This red candlestick now, it has also showed us the sign of imbalance there. One easy way of knowing imbalance, but just look for a big or a fat red candlestick, or a not just look for a long candlestick, because a long candlestick means the volatility at that particular moment was very much. So look at this red candlestick now and look at this green. You see that they are always so they are long, they are so big. So the moment you see a big candlestick, just know that what at that particular moment there was an influx of buyer or seller pressure. So it means there's an imbalance there, right? Sometimes the imbalance might not be there, or sometimes a week of this candle might can come up to fill in the imbalance, but most at times it does not come up like that. Okay, so now this is just, let us see if the market is going to fill up this imbalance completely. Okay, you can see now the market is actually, let's see if the market is going to come down to fill in that imbalance. Are you seeing it now? So in this particular case now, the market has what this particular place is a balanced market, right? This particular place now is a balanced market because the market has actually come down to fill in the imbalance. So now we don't have now like this number, the market is not imbalance. The market is balanced at this particular point because we don't have an imbalance there now. That is considering this imbalance that was formed here. Right. Now let's look at this particular imbalance now, right? Since we already have an imbalance here now, this is one imbalance there now. Right. So this is it here. How do you not get it? Of course, I say look for the first candle and the third candlestick. Right. So this is the first. This is the candlestick of the week of the first candlestick. So you can see we have here, and then now let me give you guys an instance now. Okay, so in this particular case, right, this is the third candlestick, right? This is the third candlestick. So we're expected to use the wick of this third candlestick, right? But look at it, the market now went up here. So this particular place now, right, this place now has reduced the imbalance. This place now has reduced the imbalance. So normally now, but we're not going to come and pick our imbalance from here. No, because the market pumped a little bit. You can see the market pumped a little bit. The market pumped a little bit to fill in the imbalance, but it did not fill it all. So now we're going to adjust our imbalance to so you see now we have adjusted our imbalance. I don't know if you get. So sometimes now, but the imbalance must not be about the third candlestick, right? The moment the imbalance begins to be filled, the moment it begins to get filled, like here, if this candlestick was to rally up to this particular point now, right, to this particular point here, then we're going to shift our imbalance. We're going to now shift the imbalance a bit upward, right? So it's once the market is getting filled, you now be adjusting your imbalance. So for now, this is where our imbalance is, right? So we're expecting this market to what? We're expecting this market to go down like this, come and fill this imbalance. Of course, it can come and fill it immediately, or sometimes it might not fill it immediately. All right, so now that is just the idea of imbalance. Now why are imbalance so important? The idea of this imbalance now, but it's not just for you to just learn them and be like, okay, the market is to create balance. No, there is where you can use this imbalance, right? And then one of the very most important uses of imbalance is that it can be used as a point of interest. Of course, you know what a point of interest is. It can be used to get your entry for a trade. So let's assume you're finished identifying your liquidity sweep entry model. You've done everything, your support and your resistance, and then it's time for you to pick a particular entry. After you've identified your liquidity, once there's an imbalance there, most likely that imbalance will be used as your point of interest, not even your order block, right? So imbalance are good tools, or should I call them tools now, or they are good concept for getting valid point of interest. So let me give you guys this example and then we'll call it a day for this section, right? So let me delete this one. Okay, so this is it here now. Let's analyze this market now to see if we can get the point of interest. All right, so follow me as I analyze this market so that we can see if we can get a let's see, let me show you practically how you can work with what imbalance, right? So now look at this particular market. Now the market started from here. I want to show you how. Now this is me. I'm just going to do liquidity sweep entry model, right? So from here the market went down, from here it pumped up again, from here it came down, from here it went up, and then it came down, right? So let us play the market. This is a typical example of an uptrend, right? So the market was okay. Now look at what happened here. We now had our change of character here. So following the liquidity sweep entry model, right, after the change of character, it is expected that you find your entry above this particular region, right? So now I need to go and find my entry above this red region, because that's the idea of the liquidity sweep entry model, because we're actually expecting what sorry because we're expecting price to go up here, trigger our point of interest, and dump, right? So now let's look at it. So now we now need to look at it, right? So now, like I said, this now becomes our first liquidity leg, right? So like I told you guys, now our point of interest has to be above this particular line. So looking at this particular, so meaning now we need to go back in time now, right? We need to go back in time to see if we can get any favorable point of interest here. Okay, so the first thing we saw, the first area we saw was this particular one. So let us check this particular place if we can get a valid point of interest there. So I'll come and squeeze it. So looking at it now, do you know why I'll not take this particular? Do you know why I'll not this thing? Now this is where you need to be very, very smart when it comes to taking or talking about liquidity, right? So look at this particular place. I want to be like, I've seen a very, very clean order block, and if you look at that particular place, there's an order block there. Right, you can say, this is a clean order block. Let me use that place as my entry. Now, do you know why I'll not use it as my entry? Follow me. Now, look at what happened here. Look at what happened here. The market was now typical uptrend here, down, up, like this, like this. And you can see the market was in an uptrend there. Then we had a change of character here. You can see we also had we had a change of character in this particular place. So if we are to use this liquidity sweep entry model, means that we are expecting price to come and clear this up place too. Right now, looking at, if you now go to future now, there was never a time that price went above there. So mean that if you are to take now this place number is liquidity, this particular place is liquidity. Now some people might go and use here as a point of interest. They'll go and say this is my liquidity. They'll now go and pick here as their entry point. Let me show you how liquidity works. They'll make you feel like you've gotten the best entry, and then before you know it, you just experience some kind of crazy loss. So a lot of traders will pick here as their entry point, right? Just follow me. A lot of traders will pick here as their entry point, right? You see, a lot of traders will pick here as their entry point, forgetting that now they'll pick here as an entry point because of this Opera taught us liquidity entry model. So this is where we saw our liquidity liquidity sweep entry model, meaning our point of interest has to be above, right? But then, like I told you guys, now you need to be smart when you're choosing your point of interest. Remember, we came here now, we actually saw an order block here, but we now identify, or we now analyze the structure that created the order block, and we now discover that this particular structure too created a form of liquidity sweep entry model. So we're expecting price to come up and clear this particular. So this is more like this is more like another liquidity too. All right, so that you're not you're a better informed trader now. You're not taking your entry from this particular place, no, right? Because you know that this particular leg is liquidity, right? So now it now forms our TLL. Of course, you know what we mean by the trend line liquidity. So I'm going to connect it as my liquidity. You can see how, and these two places, they are now my liquidity. Coming. Right, so now this is now my liquidity. Of course, you can see how we have the trend line liquidity there. I think if you have to watch this video the second time, watch it the second time so you understand what I did here, to analyze that and see that this place is actually is a liquidity, right? Because I still apply the same liquidity entry model here, and then so that I now discover that the market will surely take out this particular place. And then since I already have the liquidity sweep entry model here and here, then I connected them to become my TLL, my trend line liquidity, right? So now I now have the knowledge that my point of interest has to be above this red line. It has to be above this red line, right? And of course, look at what happened after. Now, what is the next structure after this red line? Now, this is the next structure after it. I'm coming. Look at the next structure after it. This is what we have here. This is the next structure after it. And what can you see there? This is an imbalance. So you can see that we have a big imbalance there. All right. So now this is now becomes our imbalance. Okay. I hope you're following me. All right. So normally now, but this would have been now. Where's the third candle? This is the third candle now. This is the week of the third candle now. Look at it. This is the week. You can see the week there. You can see the week of the third candle, right? So I have identified. So you can see this black. That's where my imbalance is. But now look at it here. The imbalance has been this particular leg. This particular leg has feeling the imbalance a bit. So now our imbalance or our fair value gap will no longer be this particular place because of what the market has covered it up a bit. So our new imbalance is going to be above this particular place. Stay with me. This is now be our new imbalance. So the entire place is here is now what is now an imbalance. So now your point of interest is this particular imbalance here. Right. So sometimes you might actually see an order block. You might actually see an order block above here. Right. If you see an order block above here, it can still the market can actually still go back to trigger the order block. But most of the time the market will just react to this imbalance and then that is the end of it. All right. So whenever you have a situation like this now, just use 50% of the imbalance. Right. Now what is 50% of the imbalance now? Just pick half of the imbalance. Now this is the entire imbalance here now. Just use your eye and pick let's pick our entry. Our entry is going to be like, when I say 50%, just pick half of the imbalance. Right, because the market most of the time the market used to always react to 50% of the imbalance. So this is going to be my what? My the where I'm going to pick my entry from. Okay. So let me put my stop loss 2%. You know me where I always use 2% stop loss. Alright, so this is my imbalance here now. So let us see if the market actually respected this our entry model now. Okay, so let us play the market. Okay, you can see, right? The market is still playing out, Let's see what will happen. Okay, the market is now approaching upward, it's going upward. Okay, just give beautiful. Have you seen what happened here? Okay, let's keep on playing it. Now, are you seeing what happened here? In this particular case now, right? We missed this particular trade. Why? Because of we used the 50% of our imbalance. Are you seeing why sometimes but you cannot really be so perfect about this particular thing? That's why sometimes but you need to learn, you need to be aggressive. That's what we call aggressive risk and aggressive entry, whereby you be monitoring the trade real life. Then the moment you observe that the traders is not going to trigger your entry, you can now manually enter the trade. So in this particular case now, look at it now. This was where our entry was. But look at where the price reversed from. So had it been I was observing this trade manually, right? I would have probably cancelled my entry here and brought it here manually, or probably cut the trade here. Instead of me to lose out on all this trade now, I would also have probably lose out on a bit. Okay, so now you can see I'll just let's now assume that we picked our entry probably a bit of, or let's pick it here like this. You can see now that we actually cut this particular trade. You can see that the market you can see that the price actually, you can see in this particular case now that the market actually went up to clear this liquidity here. I don't know if you get, so anybody that had used this green area as his point of interest must have probably been stopped out. But you that now use the fair value gap, you can see how the market neatly use your fair value gap to sell. Right, so this is exactly how you use your fair value gap as a point of interest. I hope that this training was interesting to you and you were able to get one or two things from it. If you have any question, please feel free to always reach out to me and I would respond to you on time. Okay, so you can see how the market is. Let's see what will happen in the market. All right, so you can see how the market is still going down, and you can see, right? So this is exactly how you use your fair value gap to trade. Right, you can backtest it and then you can see for yourself, and of course you're going to find a lot of examples and a lot of illustrations and how you can use it to start trading profitably. See you guys in some other training.